We'll dive into Shift4 over the next 50 minutes or so. We have a relatively intimate group here. We do have a fancy technology this time around where you can scan the QR code and the questions will pop up here if you have questions for the guys. But frankly, if you want to kind of raise your hand and shout them out in this size of a group, I think that will work as well. So very exciting company, a lot of topics to discuss. Can I start with Jared? I don't know if you have any opening statements, just your general comments to make. We can open up with that.
Not especially. Everything's working kind of as it should. So I mean, we get a lot of typical questions right now about what we're seeing in the macro, and I mean we're setting records pretty much every day, but we should if we're growing at better than 50% year over year in volume growth, you should be setting records all the time. So it's from our perspective, we got to get to a couple, I'd say, important milestone days, like seeing Mother's Day and Memorial Day weekend are important checkpoints for us. Because this is interesting relative to other periods of uncertainty in the economy that we've seen in the past, or actually even downturns. Obviously, Great Recession, pretty much everyone stopped spending. Although restaurants did pretty well, actually, relative to others. Right now, it's a really interesting environment, right? Because if we look at advanced bookings, talk to our customers that are in Las Vegas or Florida, they're like, we're gonna have a bang up summer. Everything's gonna be amazing, right? We know travel and leisure is doing well. Our new verticals, e-commerce, sports, entertainment, stadiums, people will always fill a stadium, even if it's not the best climate. Maybe the price of the hot dog goes down from $100 or something. But what's really just unknown, right, is are people are going to go out and have a burger and a beer on their main street restaurant, right? Are they going to do it at the same frequency that they did it last year? When there was a lot of euphoria and people were eager to get back out, and that's really important right now, for us. So I think our big checkpoint will be, Memorial Day weekend. From there, we can have a much better sense. From our perspective, this is not really a product of today's climate. We've always grown based on taking share.
Yeah.
I mean, even in 2020, we grew payment volumes double digits when restaurants and hotels weren't even generally allowed to be open. We took a lot of share. So that's what we have to focus on, is just, what we can control. We can leverage our strengths and win new customers, and we can control our expenses. And that's pretty much how, we've set up our year and what we've communicated to our investors.
Yeah. Got it. Okay. Well, that's very helpful overall comments on the macro. Speaking of burgers and beers, I want to start going through the different verticals where you focus. I want to start with restaurants, because that's, correct me if I'm wrong, but that's kind of the historical core of the company, maybe where you started, and still remains a very large portion of what you do. So on that specific question on your recent rollout of SkyTab, I'd love to talk a bit about that, and maybe starting with the question, what motivated you to kind of make the investment in the development of SkyTab? Why now was the right time? Maybe compare and contrast what you had in your legacy systems versus what you have now in SkyTab from functionality perspective, et cetera.
I mean, SkyTab was always part of the plan, even back in 2017 when we started acquiring other restaurant brands. I mean, just to be clear, give you guys a sense for how long we've been doing this. We were bundling our own restaurant POS software, hardware, with an aim to monetize through payments and put a SaaS bow on it going back to 2006. We did that under an organic initiative as part of a brand within our organization called Harbor Touch. We had a lot of success with that. That was what ultimately emboldened us to go out and buy several other POS brands. Now, at the time, it was the revenue synergies from doing these deals are extraordinary. You're buying this $2 million EBITDA business that has, 20,000 restaurants using their software, pumping through $20 billion, and they're making nothing off it. It's yeah, we're going to buy that, pivot the revenue model, and obviously those were extraordinary deals. But for the long term, you're not going to want to carry 4 or 5 different, restaurant POS brands. You're going to squeeze all the synergies out of it. You're going to learn as much as you can. You're going to apply that talent to building something better. So more than 5 years ago is when we started the SkyTab POS product initiative. It's when you have such share within the restaurant vertical and such powerful distribution, you're never going to cede ground with that opportunity. So we started building SkyTab again probably 5 years ago, and it reached kind of its it's not peak maturity, but it got show ready at the end of last year. And that's when we said, look, a lot's changed now. It's not Windows-based systems, it's cloud-based systems. Do you need as much of the operating leverage you got with local distribution in the past? You need it as much now. And we were like, this is a great opportunity to consolidate brands, in-source distribution, take control of the customer experience, and rally everyone around the SkyTab banner and sunset those older brands. And that's what we did in the second half of last year. The results right now are just extraordinary. I mean, can dramatically change the margin, free cash flow profile of the business, substantially improve unit economics. Every new SkyTab customer we sign up today has a considerably better payback, has a lower customer acquisition cost and a much quicker payback than any other restaurant POS customer we signed up in the 14 years prior or whatever that we were doing restaurant POS. So all things pretty happy. And generally it's a landscape of two, right? I mean, it's really Toast and Shift4 that's out there. There's nothing really that cosmic about ringing up a cheeseburger. It's about, having good coverage with a decent product when customers are ready to migrate from an older solution that's costly or a legacy provider that's not adding as much value anymore.
Yeah. What drives the better unit economics of SkyTab? Why are customer acquisitions lower than for the legacy products?
Yeah, it's in two parts. One, it's Android based now, so Windows hardware just costs more. I mean, just a Windows license on our older generation POS was probably 10% of like the solution cost. Android, the operating system is free. The hardware is it's not as not as bloated. Like the software in itself is not as bloated as a Windows environment, so you don't need as much processing horsepower. So overall cost of the hardware is meaningfully less. And then you don't have the ongoing revenue share because you have a direct sales model now relative to the past third-party distribution. Mm-hmm. So in the past, we were paying out, 45%, 40% or so of like our processing-related revenue streams to our third-party distribution partners. We've now insourced all of them. So we traded that ongoing variable expense for a fixed cost. But like it's a worthwhile trade, especially in markets that will continue to generate new sales, which they are.
Yeah. Okay. And I do want to come back to the distribution strategy in a bit, but a couple of more questions about SkyTab and restaurants. So you mentioned it's a market of two versus Toast. Obviously, Toast is on everybody's mind as the winner, presumably in the restaurant space. Can you maybe pause on that for a second? Compare, contrast for us. Is the functionality, because I think there's a lot of maybe confusion or lack of clarity for folks out there. Is the functionality of a system like SkyTab basically the same as let's say what Toast offers?
Yes. Really, guys, I can't. Hopefully no one's talking any AI craziness yet about what's going on when you ring up a cheeseburger. Actually, I think Wendy's now is thinking about something like that. But realistically, seriously, how does it go in a restaurant? You're all, patrons in that environment. Extra cheese, no tomatoes, add mustard, side of mashed potatoes, right? Like they all do essentially the exact same thing. There are some like total table stake items that you have to have. Like you got to be in a cloud-based world right now. It takes so much burden overhead off of the restaurant operator themselves. You have to have integrations into all the delivery players, your Grubhubs, your Uber Eats, your DoorDashes. You have to have loyalty. You have to have online ordering. You have to have like a mobile manager app. Those are the basics. Like we're same, right? Now there are kind of some ways you differentiate with some sizzle features. Toast absolutely caters more for like they want to win the brand new restaurant. Mm-hmm. Capital offerings with like high APRs. Like you're not winning like a well-established restaurant by offering them like a loan with like a 40% effective interest rate or something. Payroll offerings, like a mature restaurant is generally with an ADP or Paycom, but a small restaurant would be like that's a nice feature. On our end, like we give away our BizIntel product, we give away our marketplace, we give away our loyalty product, we give away online ordering. We totally, like if you do a side-by-side comparison between Toast and Shift4, they charge for a lot more on software because at their core they were a software company and their take rates are, meaningfully less than ours. And us, like we give away the software, the hardware, we charge very little SaaS, but we monetize more through payments. Yeah. But just to be clear, like that bar and grill on Main Street is not RFPing Toast and SkyTab. Like we're not coming there, and going blow to blow with them. Like they're leaving Heartland, they're leaving FIS. Like these are Heartland at one point had like the lion's share of the restaurant market when they had the National Restaurant Association partnership for 20 years. This is purely like a Toast or a Shift4 salesperson being at the right place at the right time when that merchant is fed up with whatever they had before. NCR has a ransomware attack. Heartland decides to have like another new fee or something like that. And they're like, you know what, I'm done. Whoever's there is winning that opportunity. Yeah. Like it's not them throwing out Toast to go to Shift4 or throwing out Shift4 to get to Toast. We're both like equal beneficiaries. And by the way, there's like very rarely a winner take all in any product or tech business. So. Got
it. And so last question on this. Timeline from here in terms of the rollout of SkyTab, kind of what are the stages, if I understand correctly, you're starting with new customers, right? And then the next phase would be to roll out into your existing base. What time frame are we talking about here? Like, is it next several years before SkyTab is the dominant platform?
Yeah, we think ultimately it'll be a multi-year effort. Like, quite frankly, we've got more demand for SkyTab than we can fulfill customer base. There is obviously, significant organizational efficiency to getting everyone on a single product, so we intend to do that over a period of time. Right now, it's kind of new customers are the highest priority, needs-based are the second highest priority. I want to switch for one reason or another. I've encountered a pain point. I don't want another Windows workstation, is another good example. And then the last base is if you're content on our existing, hardware, software solution, we're happy to keep you there as long as you'd like, and SkyTab is available to you. One day you'll wake up and there'll be, a free upgrade option in our business intelligence portal for you because that organizational efficiency will be, basically the last benefit to squeeze from it. But right now, new customers are 100% the focus.
Got it.
Yeah, I mean, for retention purposes, if it's a way to save a customer, we'll absolutely upgrade them. But like you'd know if we showed up into a quarter and we're like, hey, we got 5,000 new SkyTabs and they were all upgrades, because it would be a huge hit to free cash flow, right? So if we're coming into the quarter and said, yeah, we've added thousands of new SkyTab customers, and like you continue to see margin and free cash flow expansion, then we're winning net new customers.
Gotcha. There's a question.
Yeah, do you have a sense of how big, if you look at the install base, what is that legacy opportunity? Because I think everyone thinks of like Square versus Toast, like who's winning, who's like the point that you're making. Not I'm just curious as to how big the runway is for all the cloud players in restaurants.
Yeah, I'll start. First of all, I would say really important to segment the restaurant population down. I think we, the software players in the space do a disservice by kind of broadly categorizing that. The market that Square serves is quite very different than even the market Clover serves, and that is very different than the markets that we've been talking about. So we focus exclusively, not exclusively, but the majority of our business is on table service restaurants. That's where we see, ourselves and Toast is really the only two games in town. I would handicap that significantly more than half of that table service market is still on a solution that is not Shift4, SkyTab, and Toast. So like the greenfield opportunity in that is quite significant. But again, you have to look at table service because the operating environment is just so fundamentally different from, a farmer's market or a coffee shop or anything else that the software needs are different. And so, we get asked very frequently about Square and restaurants. I think it's been a stated objective of theirs for a long time that they are largely not in table service restaurants, but they are incredibly dominant in, all these other areas of the food service business.
Yeah, I mean, you're talking like four winners there, just so you know. Like, those are all companies that are going to win, and they can do that without really hurting each other. Square and Clover have some overlap for sure, but in markets that you would never see Toast in. I mean, like, a convenience store here that is also a deli, like that should be on Clover. Maybe they graduate out of Square onto Clover, like, food trucks and coffee shops. Like, really, like, unless you're really gunning for location count, like, you shouldn't be trying to put a Toast or a SkyTab in there, because just like the total cost of ownership over time doesn't make sense for a business that's doing $250,000 a year in revenue. It makes sense for $1 million a year plus type customer. So I think all four of those, by the way, like, they're all beneficiaries of merchants leaving non-integrated terminal solutions, older Windows solutions, even cash registers, and there's not a lot of like beating each other up, like, of those four, who are the two last ones standing. They're really serving different lanes.
Did you ever run into UCP for global payments for World Pay Total from FIS?
What is UCP? This might even be an answer in itself.
I forget what the exact acronym is. It's like an omni-channel solution.
So, like, global payment, is this like a restaurant-specific type?
Sure, yeah.
Okay, so like, for example, like global payments, like, we would know that what was used to be called Mobile Bytes is Heartland POS, is like their only restaurant solution. You don't see it anywhere. And like the other brands they had before that, like Dinerware and Digital Dining, have all like closed up. And FIS, like, I've never seen them with a product anywhere. Like they were pretty big on partner with everybody, and that was actually, I think, ultimately their downfall, is all those partners got swept out from underneath them. But like I've never seen them actually have a product out in the market that they're directly selling. So I'll look these up, but yeah, I haven't.
Yeah. There's another question there, and maybe we'll move on.
With the competitive set, I think R has talked about more table service specifically. I think they're also bundling some other stuff in their solution. well. Do you see them in the market? How do you think about their solution?
Yeah, I mean, PAR's in fast food for sure. They are. I've never seen them in a table service environment at all. That would be pretty surprising. It's like interesting. Like they spent a lot of money buying a loyalty product, which that happens to be one of our sizzle features is free loyalty. It's relatively simple in order to do it. Like it's either frequency based or dollar redemption based. Like pretty simple calculation there. So like I don't know. I mean I think they're going to stay in their strength, which is if they stay like if they're in QSR, they're only competing with dinosaurs. Like Brink is probably a best in class for fast food, and but like they'd have like a really tough time I think moving in table service, but I don't know.
Great. All right, good discussion on restaurants. You do have other verticals, so let's move to those and a couple other topics. All right, next one, lodging. Obviously, big growth vertical for you guys the last couple of years. When I think lodging, I think the gateway opportunity. I think that's being the core of your strategy. Correct me if I'm wrong. So maybe let's talk about that. Maybe a year ago or less, you announced sort of an acceleration of putting foot on the gas for gateway conversions. That's how I interpreted it. How is that going? Maybe give us a little bit of an update. Is it accelerating? Are you seeing faster conversions there?
Yeah, I'll start. And maybe just to level set, what is this gateway opportunity? If you're a hotel, it's not a question of which software you want to use, like any of the names that we threw out here. It's a question of which payments provider can work with all of the software across your ecosystem. So take where we are today. There's front desk, there's online reservations, there's probably a salon spa, there's multiple restaurants. Every one of these is a different piece of software, and they all need to be compatible with a common platform. So your guests get a common experience, the security is of a consistent standard, your analytics are useful. You know how much is being spent across your estate, and we are immensely advantaged because we own, a gateway that has 500 software integrations. That means we're usually the first call for a hotel that says, I can assume that Shift4 can support my ecosystem, whether that's Pebble Beach or a Best Western. So the technical capabilities give us an extreme advantage both in winning new hotels and in the hotels that had signed up for that payment gateway throughout its history as an independent company before we acquired it. It's important to note we acquired, the larger of the two payment gateways we did just before the pandemic. So best laid plans to win a lot of business over from them. 4 months into their acquisition, most of these businesses were shuttered, and in the hotel case, many didn't open for well over a year. We entered 22 saying now's the right time to kind of continue on what was ultimately our acquisition thesis, which is the better go-to-market, both for the customer and for ourselves, is that we're not just a gateway sending all this volume to a bank that's earning 50 basis points, that we do all of the functions for the customer. The customer saves time, they save money, it's a much better technical experience, and we get substantially more gross profit. The loser in that equation is, the bank. And so we said, we're just going to sort of organizationally enact the things that we had laid out in our acquisition thesis, which is over time, we're not going to offer to be a gateway. We're not going to continue to sign gateway-only customers. We are going to price the solution to what we think is fair for the level of differentiation, the level of service that we're providing. And all that has worked exceptionally well. So what you've seen over the last year is we've added a really substantial number of enterprise customers. That's a result of kind of these actions. And it's quite frankly, it's a very simple conversation. It's you are trusting our technical solution with the majority of your revenue collection. And as a gateway-only provider, we're just not paid enough to place the emphasis that you'd want us to on that. And so, but if you can use us as an end-to-end provider, you can save money, and we get a really substantial lift in gross profit. So we tried to lay out in our last earnings materials a table just to kind of illustrate what this has looked like, which is that just prior to the pandemic, we had 3 customers who were delivering us more than 100 million of end-to-end payment volume. As of the recent quarter, we've got 50, and half of those have come from exactly what I talked about, which is they were using the gateway-only service. Now they're using us for end-to-end, and we think that pace of kind of winning big customers is going to accelerate for 2 reasons. Number one, we just really didn't have an opportunity to speak to these customers over the past few years as a result of the pandemic. And number 2, they do take longer to make a decision. So they're starting to make these decisions, and we're benefiting from that substantially.
And maybe just jump on it. A lot of people associate our kind of growth and dominance within the hotel vertical specific to our gateway advantage, which is a huge help. And we had 200 billion of, pretty captive volume. And to Taylor's point, it's pretty easy between a combination of some carrots and sticks. You can save them money, have like that one throat to choke, and it's a massive lift in gross profit for us. We pick those customers up. But that's like half of our production. The other half is we simply just win net new customers all the time, including the hotel vertical. So we try and put that into, our earnings material like every quarter. Like, sure, gateway conversion is working. There's 150 billion more to go, so hang on. But we also win the new ones. So like this past quarter was VAI. Largest new, pretty cool cover if you saw the earnings report. This massive new resort will be the largest resort in Arizona, which has some pretty awesome resorts. It almost looks like a Vegas resort in the middle of the desert. That's a brand new cloud-based property management system. Like it's $1 billion VC unicorn. So for anyone who thinks it's like, well, it's all old Oracle and Agilysys stuff. No, we have all the new cloud-based PMS systems too, and we win the new ones. I think a quarter or two ago, Nobu in Atlanta, brand new property in Atlanta, new PMS system integrated to Shift4. We unfortunately we couldn't disclose the names. People seem more sensitive to that now, but two new Vegas properties. Those are both brand new resorts using new property management systems that we signed in the last quarter that are on Shift4. So we win a lot in lodging. We're super lucky to have our gateway business because it's like the yellow brick road for new for growth. We also just win net new customers too.
Yeah. So. Great. All right. Moving on to other verticals. So in addition to restaurant and lodging, you're going in several other, areas, probably gaming, stadiums, entertainment arenas, e-commerce, nonprofits, kind of top of the list. There's others, and international I want to talk about separately. The overarching question I always have on that is, what do you feel like gives you the right to win in these distinct verticals? Because I think what we've seen in general in this market, it's much easier to win, obviously, if you're Toast. I'm the restaurant specialist, I invest everything in designing those systems. So when we see you really trying to go very broad, it's ambitious, it's impressive that you're trying that, but what gives you confidence that you can actually do that across many verticals?
I don't know, 65, 66% year-over-year volume growth. The fact that it's working. We've been growing volume really fast in revenue for 24 years, so we do know a thing or two. Like I think some of this is like not PowerPoint. It's pretty reflected in the numbers. Look, that said, some of the most like absolutely badass payment companies in the world serve like untold number of verticals. I mean, take Stripe and Adyen. Stripe and Adyen, they don't build a Netflix product, a Microsoft product, an Uber Eats product. They're an amazing payments platform that attracts integrations from software companies to meet their requirements, right? We built a payment platform that meets the needs of certain software companies and certain verticals requirements. Now, it happens to be on the least sexy verticals, the ones and maybe I actually think that they're awesome and sexy verticals, but what people like is the visibility of seeing oh, that's a Square terminal. I know what that looks like. Look at that. That's a Toast terminal. That's a Clover terminal, right? You'd have to go into the mainframe room at Caesar's Palace to see the Shift4 magic, right? So we specifically cater to the most demanding and complex payment environments in the world where no one piece of software can make it happen. If you can download a piece of software on an iPad and run the business, that's Square's world. And then when they graduate out of Square's world, they're going to Clover, right? We have almost every ski resort in the country, and it's not just the hotel portion. It's the ski rental shop is integrated to Shift4. It's the salon and spa. It's the 3 restaurants and the gift shop and all of that. That's where we thrive. And actually, when you zoom out and look at the verticals that we're playing in right now, they all share those characteristics. We were surprised about stadiums. We had one stadium at the time of the IPO, which was Raiders Stadium, and they were using the same Oracle software that was in every one of our hotels. So we were like, sure, we can do this. But then when you looked under the hood, you're like, man, it's just like a hotel. They just don't have the hotel rooms. They've got restaurants in them. I mean, some of the ones have nightclubs in them. They've got the VIP suites. They've got a merchandise store. It's generally all different software. So we're we can do this. Actually nonprofits was another surprise. But then when you realize, this isn't a world where people are just sending a $20 check to their charity anymore. You can have people streaming, Fortnite and making donations. You're doing YouTube stuff. They're using lots of different software. In the end, you're trying to get it all populated into a common donor management database. But all of the verticals we are trying to conquer all share those same characteristics of lots of different software that integrates into a payment platform that's designed for that purpose. Which is no different, again, from Adyen or Stripe or any other really amazing payments company that's trying to attract software integrations.
Yeah. Are you competing with Adyen for some of those mandates, or who do you see most often?
I mean, we generally try and pick verticals that the best in class players out there can't easily play in.
Yeah.
Like and for example, in hotels specifically, I mean, you need to have 500 software integrations and 20 years of version history in order to ever be able to respond to an RFP from Pebble Beach or Caesar's Palace or something. So we intentionally try and stay out of lanes like we like when our competitor is like U.S. Bank. Yeah. That's a good one. That's our biggest competitor in hotels. So, I think like gaming, for example, is another good one. We were so advanced. 40% or so of the casinos in this country, like the physical casinos, are our customers. Should totally go for gaming. I would hope if we could leverage the data, the tokens we have in an in-venue casino, that gives us a right to win the mobile gaming solution. So we try and have a pretty significant advantage if we're going to dive into a vertical, because anyone that's purely going head-to-head with Adyen and Stripe, if you don't have some extra magic or sizzle to differentiate, you should lose.
Yeah, makes sense. All right, let's talk about international quickly. So big strategic growth vector for you guys potentially. I guess talk about, it's a huge opportunity, huge market. What's your strategy of approaching it? How do you get a toehold there? And where we are right now in that journey?
So it's a few things. This has been something we've been working on for quite some time. If you think about the merchants we serve, we've got a handful of the key ingredients for success around the world. We have the software integrations that are being used all over the world. We love to illustrate the Hilton in Madrid is using the same software as the Hilton in Times Square. It's integrated to Shift4. We can serve the merchant in that capacity, and we have the relationship with the merchant. What we don't have is the local payment methods that are prevalent that merchant demands inside of their geography. And so it's been a multi-year effort of us exploring how are we going to tackle this, what is ultimately a big, complex problem of, supporting all the local payment methods that are relevant for our merchants. We've been fortunate through innovation and relationships to win a handful of big global e-commerce merchants that have committed to giving us business in any country we can serve them, and that's emboldened us to kind of accelerate this international expansion strategy. So we announced that we are acquiring a European payments platform, which is unlocking an entire continent for us, with the plan always being we're going to double back now and make all the card present magic that's made us successful in the U.S. work there. And what's really, really compelling about that is there really isn't the concept of software integrated payments throughout the world anywhere near how it exists in the UK. How it exists in the US. You still go to many countries, and even if they have a piece of software, they've got a local bank terminal that's not at all integrated to it. So to Jared's point, we've had kind of 20 plus years of success integrating software and payments here in the US in a highly competitive market, and we can bring those capabilities overseas. Very happy to report we already have, it's through partnership because we don't own this acquisition yet, but we already have, SkyTab transactions working in restaurants in Europe, by way of example, and that can be just a huge market for us. So it's in many ways taking the playbook that's made us successful in the U.S. and just identifying markets where they're not necessarily at the same level of maturity and saying, how can we get there?
Yeah.
Look, it's a giant TAM expansion opportunity. I think a lot of companies when they talk about TAM expansion, and especially the unprofitable ones, is this is why you can have comfort that eventually I'm going to have this all sorted out because it's huge, right? We've been competing in the U.S., which is a super competitive market for 24 years right now, and we've grown revenue every single year in that. We are profitable, and we have customers that have locations all over the world, and we've been afraid for the longest period of time to make that leap because international integrated payments is super hard. Super hard, right? Visa MasterCard was a nonprofit organization for the longest time, and every bank was treated equally, specifically so a major U.S. bank couldn't go into another market and bulldoze it, right? So it's been designed to be hard. And then they came up with all their local, debit methods, their own encryption standards are different in different countries. There's not just the general EU standard for this, so it was made really intentionally be hard. Now, those that have success, and you're talking really only to, again, is Adyen and Stripe that have a really good global commerce solution, they did it with card not present e-commerce because it is a nightmare to do it in card present. So we were we want to do this. We have the customers, we have the integrations. We know if we make it, if we're profitable, we're growing really fast in the U.S. We should be able to there's restaurants and hotels all over the world. We should be able to take our products into those markets and find success. But how do you really de-risk it to be willing to embark on what is a challenging journey that no one has done from a card present perspective? And it was one really premium customer, a great relationship that said, I will give you this yellow brick road all over the world. You follow us. We'll tell you what we like, what we dislike, what we've already learned because we're already there and you're not. You'll make your product better, make us happy, and then once we're there and we've got it figured out, you bring all your restaurant, hotel, and stadium integrations, everything that made us successful in the U.S. into those markets because they have restaurants, hotels, and stadiums. So that's like the whole game plan, and we're really far along with the Finaro one. Like from the time we announced that deal 13, 14 months ago, it's a better company today than it was at the time we signed the deal. And we've had plenty of time to work through our integration approach to such extent that we've been dating long enough that we should be able to get married and then go on and look for our next bride, which is what we're doing now in other continents.
Got it. All right, we're going to be looking forward to that being resolved finally. Moving on to a couple of other topics that I wanted to hit before we run out of time. One is coming back to the distribution strategy and what you mentioned, Jared, right? So that was a relatively big strategic move last year.
Sure.
You acquiring 50% of your third-party distributors, insourcing them. So just taking a step back, historically, you really liked, I think, and relied on the third-party distributor model. It seemed to be, pretty core to the company as they, gave you flexibility to grow, et cetera. That's how I'm thinking about it. Why the decision to make this move now or whatever, like last year? What prompted it?
Yeah. I mean, at some point or another, you had to let go of the legacy brands that we acquired in 2017. So we squeezed all the payment volume out of it. Now you're maintaining a lot of Windows-based POS systems. I mean, by far, if you look at, call it 2,400 employees, more than half our workforce is supporting restaurants. Like that is your most labor-intense, high overhead. You can have one employee supporting a multi-billion-dollar, hospitality customer, and you need like 1,000 employees to capture the equivalent in restaurant volume, right? So you got to unlock efficiencies. You have to delete the parts, sunset like your Windows-based POS products, and align everyone around a common product. That's hard to do, right? Like our 4 or so, POS brands. Plus, we played really nice with Micros and Agilysys. We're able to differentiate based on their product brand and their software. And now you're saying all that has to go away. Right, so that's like a forced migration to a new product. So knowing that was like inevitable, that you had to do that from like the sake of brand building and operational efficiencies and concentrating resources on single product development and everything else, like how do you do it? Right? And now at the same time, you also have the advantage of a new cloud-based solution where you no longer necessarily require the same amount of resources in the field to support the customer. But you still want local service and support. That is an important way we try and differentiate from the other player out there. But it's not as labor-intense in the field as it was previously because it's cloud-based. We can log in, see what they see, make a change. They see the change we made, so on and so forth. So that's what kind of gave us the rationale of you have to do this. You have some advantages now with cloud-based product to say, like, let's pick off our best partners. Let's bring them in-house. These are the best relationships we've had for like 15 years. They built the business for the last 10, 15 years. You know which markets are going to be successful based on just historical customer base and, production trends. Say we're going to bring them in-house. It's obviously dramatically changes the margin free cash flow profile of business. But again, it's huge unit economic enhancement here. Quicker paybacks, lower customer acquisition cost. And then in markets where you're unsure, the more sparsely populated areas where you don't want to trade a variable cost for a fixed cost, you keep those partnerships rolling. And that's exactly what we did towards the end of last year. And by the way, like I put that in my shareholder letter at the beginning of 2022, which is the road is uncertain right now. Like we don't know if the $100 stakes are going to last. Like the good times of 21 are look like they're coming to an end. Our promise is to prioritize our resources towards the absolute needle movers. And that's exactly what we did. We focused on a couple key things: gateway sunset, launching a new restaurant POS product, insourcing distribution, and the results of it were extraordinary. And it's played out way better than we've expected. I mean, you got thousands of new customers coming every quarter from SkyTab.
Got it. Great. Okay. And now the topic I wanted to talk about quickly, at least, is the unit economics, the direction of the yields, et cetera. I think that's an important topic for you guys. So starting with the yields, investors look at the yields closely. So first, when we compare your yields to the other players in the industry, they are very high. I think you've already mentioned it, Jared, and I think that, correct me if I'm wrong, that sounds like just a function of almost how you monetize your products versus the others. So that's probably a very important point. But then now they're coming down, and it comes in spurts. I think last quarter was kind of a big year-over-year drop, 4 bps sequential drop. Can you talk a little bit about what's driving that and what can we expect going forward on the yields?
Yeah, you guys should both weigh in this, but I want to set the stage because it's like, I think rightfully, like a lot of investors are like, Like I don't even understand payments anymore, and I hate it all or something at times, right? Because it's confusing. Like who's winning, who's losing, who can I trust, who can I not? Like to be really clear, like there are no real price wars anymore. Like that was a time that was like of a different generation when scale mattered and there was a lot of consolidation going on. Right now, like actually like the good platforms, like we get really good take rates. Like if you're adding a lot of value from a commerce experience perspective, you're getting good take rates. I mean, look, in the last probably quarter, Stripe, Toast, Shopify, they all went up in price. If you want to use our online ordering modules, you want to use they all went up. Everybody's taking more. Square added a subscription fees to like every one of their third-party services. Like you're adding good value. You're getting decent take rates right now. So when you see take rates come down, like this is purely a factor of mix where you are going from 17 years of our history serving just the Irish pub on the corner that does between, I don't know, 800,000 and $1 million a year in payments. You get like 90 basis points, right? But when you sign up like the Washington Commanders or the Baltimore Ravens, they're not paying that, right? You sign up like a multi-billion a year hotel operator, they're not paying like 70, 90 basis points. But it's like, there's got to be like, like crazy market forces at play here, like highly competitive. Believe me, like there is no way a major NFL stadium or a multi-billion-dollar hospitality operator is switching for 3 basis points. I mean, the Four Seasons went from like 600 a night to 1,200. Guys, they don't care about 3 basis points. What do they care about? Mobile check-in, because they can't get people for the front desk, right? Like it's all about adding value through a broader commerce experience and very, very little to do with an approval or decline anymore. So like, what is the KPI that matters? If you are growing volume, you are adding value and you are winning. If you are not sharing what your volume KPI is anymore as a payments company, you are shrinking and you don't want to talk about it, right? So like moving that needle first makes sense. And if you're moving up market from 800,000 a year customers to like 4 billion a year customers, yeah, you should expect take rates to come down. But I still think like we are like relative to anyone that we're compared against, like we're meaningfully higher because 85% of our restaurants don't pay any SaaS fees at all. We choose to entirely monetize through payments. And with hotels, like where we're often like, criticized, look at these guys' customer acquisition costs. They give away devices. But you get 10 basis points more on like $2 million a year. It pays back in 9 months. It's actually smart. So anyway, please layer in.
I think you said it well, but I think the key is just to go back from all that and just say this is a blended spread. It is not a compressing spread, right? And so we've tried this a couple of different ways over the last couple of quarters. I'm hoping we've hit the mark at this point, but our high growth core and our historical business spreads are consistent. They are unchanged. They're as solid as they ever were. When we came out this quarter, and I think even when I look at kind of exiting Q4, we were about 71 basis points. We messaged, that we started Q1 right in line with Q4, but we knew, right, that we had a large hospitality client that was coming in that was going to bring those spreads down. That's just math, right? It's a blended spread. And I think that's why we tried to give out the trajectory for this year of kind of saying full year should average about 65 basis points. The choppiness, and this is just new to Shift4 as we're going up market and we're bringing in behemoths, is that it could be choppy, right? Quarter to quarter, we've joked that maybe we should have waited 1 more month to bring in that hospitality client and had a quarter of spreads that looked just like Q4. And of course, not having that large enterprise hospitality client in for a whole quarter, it will blend it down slightly as we go into Q2. And that's why we thought putting that measure out was so important. I think, though, it would be remiss not to just mention what I think has already somewhat been stated. There is an offset of the service model, in exchange for a lower take rate. You also are investing lower SG&A, right? And that's why we're able to expand margins over time, even with a blended spread coming down. So I think EBITDA margin and free cash flow conversion is really the test point at the end of the day of the model. And I think those kind of have spoken for themselves.
Yeah, I would if spreads weren't coming down and we were dropping the same logos that we have been in our quarterly earnings reports, that should be a huge red flag. Like, how is that possible? Like, man, that product must be really good. They're going to be a 1% partner in an NFL stadium that's worth $5 billion or something, right? Like that should, I would think, like, instead of reacting the other way, it's like, the product's winning and it's just making sense given the size of the customer. If take rates weren't coming down as we're mix shifting up, that would be a red flag.
Right. Great. Okay. Well, perfect segue into a conversation about EBITDA and free cash flow, because I did want to hit that again before we run out of time. First, very simple question I get asked often, and I don't know if I have a perfect answer to it. What's the secret sauce? Why are you able to be consistently profitable? Let's just start with that simple question. Whereas the peers who are seemingly competing and doing basically the same thing are, in the red, pretty deeply in the red, frankly.
Yeah.
What's the secret sauce?
The secret sauce is we were a basement startup in New Jersey. That's why. Like there was no Series A, B, C, D, E in Shift4. Like it was $10,000 seed check from my grandfather, and you got to pay your own bills from here forward. I mean, honestly, that's the truth of it. We were EBITDA positive. We started the company in late 1999. We were EBITDA positive in 2004. First outside capital that we took was in 2014, our first acquisition. We financed all of our growth. Like making payroll meant taking in more revenue than expense for the bulk of our history. So like that's more our DNA, you know. It's just a more disciplined approach. Like you look at like when you're hiring people, that what you're paying them is like, you know, your cash that's going out the door. You know, where our actual like normalized stock-based compensation is like, you know, sub 1%, because at the time of the IPO, we had 2 shareholders in the company. There wasn't a stock-based plan. Now I'm big in equity alignment, but it didn't exist prior to the time of our IPO. I think we were raised as a completely different organization that, you know, cash won't always be waiting around the corner, and had to have an eye on profitability. It means like you're challenged to find a better way, right? Like exactly like the Focus POS acquisition this past quarter. Like you got $45 million of cash you probably didn't know we had. You could throw it towards digital marketing and Google AdWords and brand building, and you might attract a lot of restaurants that go out of business in the first year because their pizza sucks. Or you put it towards a company that has 10,000 customers, highly sticky on their product, that do $15 billion a year in payments, and you probably synergize that thing down to less than 1 times. Great use of capital. I mean, that's what when you're using your own cash the entire time, you find a better way to get there. And that's not like knocking the other way. The other way works. If you time it right in a zero interest rate environment, you can create some pretty extraordinary businesses. And I think Square and Toast have great products. But you know, they're much more of like, I think like a West Coast success story from Silicon Valley than kind of how we do things.
Yeah. Got it. Okay. And the path from here on EBITDA margin, and I'd love to hear your thoughts on free cash flow conversion. So the trajectory of improvement maybe on both. What drives that? What should we expect over the next couple of years, kind of medium term?
Yeah, look, we've kind of talked about this year's trajectory. You could get it from the guide that we do feel like there's still some expansion from here. You know, we are very thoughtful. I was thinking the word that Jared said, which is disciplined. So we are investing when needed for growth, right? You can't not invest, right? We talk about headcount flat, but that's offset by talent upgrade. So we'll make choices when it feels right to propel growth and stability for future growth. But look, we think there's room. And, you know, I know Jared hasn't used it in a while, but when you look at kind of where Adyen is versus where we are, we think there's room somewhere in between. We'll never get to be an Adyen because we have our legacy high growth core, which has a higher, you know, intensive service model, but we think there's still room. And so, I mean, I think with the discipline and the blend of the business that we're bringing in, we think you'll see some more from here going forward.
Yeah, on the margin. And on the free cash flow conversion, just to point on that specifically, how quick, so now you kind of in the 50s on the adjusted measure, some gradual improvement this year. I know the first quarter was much higher, but I know it also facilitates quarter by quarter. Over what time frame do you expect to get to, you know, to the 80s level, which I think when you look across mature companies, that's where they are.
Yeah, I'll be quick. We probably will never get to the 80s because our model is, you know, equipment and our capitalized acquisition costs. Like we like our model, right? So when you compare us to others, we do have a little bit more capital intensive model that we trade off for other cost and unit economics. So again, I would give you generally the same answer. There's room, but don't look for us to be at an 80% free cash flow in the near term.
Yeah, this is like we don't want to be a mature company. Like, just to be clear, like if we're not investing meaningfully in customer growth with good profitability, like that is a huge caveat, then I don't think, you know, the company's on the trajectory that it has been on for 24 years.
Got it. Great. Okay. Well, we covered a lot of topics in a relatively short time. Jared, maybe you can close off with you know, your current elevator pitch. Why is now the right time to invest in Shift4?
Yeah, I mean, time of the IPO, when people first, you know, bought into kind of the Shift4 dream from a public perspective, we had like, I don't know, maybe like 80% of our business was from restaurants, like a substantial portion in a single vertical that at least during the pandemic was like for a while regulated closed. We actually were able to grow through that in double digits revenue and volume perspective. Like the business since that time, like we even said, if we're able to pull an IPO off in this climate, right? Like we have to emerge from this a more diversified and stronger organization, right? Since that time, moved into vertical of hotels. Not like they exactly fared much better than restaurants did during the pandemic, but we have a lot more of them now today than we did before. specialty retail, and then moved into new verticals, right? E-commerce, gaming, travel and leisure, nonprofits. Now, at the time we set expectations for investors, like right when the euphoria was fading in late 21, we had nothing more than an anchor customer in every one of those verticals. Commitment from St. Jude, a commitment from a very strategic e-commerce subscription player, a commitment from BetMGM. We had no integrations at that point. Like, we had to build it. We said we're going international, but we didn't have any means to authorize or settle transactions in Europe at that time, right? We got through and beat our first year midterm outlook, and basically in the second half of the year got those integrations done and set ourselves up for year 2, which we're in now. This is the easy year, right? Like, all those integrations are done, and you're getting the annualized effect from all those behemoths that we signed last year. And you've got, like, the international on a path where I said it's a better company today, in the case of Finaro, than it was at the time we've signed. So the point is, in terms of delivering on the expectations we told you at the time of the IPO, look at every one of the KPIs that are associated with it. Look at every vertical. Look at the penetration within it, and we've exceeded expectations. And I'm telling you, it's easier now than it was at the time we set those expectations. So.
Okay. Well, thank you very much. Really appreciate it.
Thank you.
Thank you.
Thanks all.